Welcome, everybody, to the Cash Flow Digest. I am filling in for our fearless leader, Matt Faircloth. My name is Jacob Sandoval. I am the head of investor relations for the DeRosa Group. It is a beautiful day in the Bay Area, California, and Matt is some big shoes to fill. So I won't be filling those shoes alone. Luckily, I have a partner in crime today. He is the brains of the DeRosa team. He is the one, the only, Hait Patel joining me on the podcast. So let's bring Hait on.
Good morning or good evening if you're in the East Coast time zone. So, how are you doing today, Jacob? I heard the
I'm
weather is really nice in San Francisco.
The weather is nice today, Hait. And the sun is always shining in real estate. So we're happy. We're happy over here. How are you doing over there in Minnesota?
We are recovering from our floods right now. We had pretty
Oh
bad
no.
flood area. We are in a flood zone at the moment in southeast Minnesota. So, right now is recovery. There's still a flood warning and everything out there, but I think we should be good to go. Hopefully, crossing our fingers, everyone's safe and sound.
Awesome. Yeah, definitely hoping that everyone is safe and sound. And sorry to hear about the floods out there.
Mhm.
So we'll kind of transition to the topic that we have today. We have a very exciting episode. Haith and I are going to first talk about a current event, a very interesting current event, especially for me being located in the Bay Area. Haith, so the article that we have to talk about today is titled "Why Some Brokers Think San Francisco's Commercial Real Estate Market May Take Decades to Recover." It is an AOL article. And I was born and raised in San Francisco, California. I'm still located in the Bay Area. So this was a current event that was very, very interesting to me. So, in essence, kind of to summarize the article, and Haith, I'd love to kind of get your take on it. The brokers in San Francisco are saying that, the San Francisco market is going to take a very, very long time to recover. And that is because of a couple of, external factors that happened that's not specific to San Francisco, but specifically hit San Francisco really hard. One, San Francisco office has incredibly high vacancy rates right now. I think the article was quoting, above 30% vacancy. So San Francisco offices are just empty right now. And that really happened for a variety of different reasons, but the largest reason being the pandemic. People, obviously, remote work became a very, very big and normal thing. And so people worked from home. And then on the back of that is people moved out of San Francisco. San Francisco is probably one of the highest cost of living areas, if not the highest cost of living area in the country. And so people just moved and then they didn't come back. And so San Francisco is having a hard time recovering, getting people back in the office. Whereas, to kind of juxtapose that with the city like New York, a lot of people in New York have been coming back to the office in New York. And I think that has a lot to do with New York being more finance based and San Francisco being a lot more tech based. So like the cultures of those kind of two different corporations or corporate cultures are very different. So anyway, brokers think it's going to take decades, of 2042, I think is the article said, Haith, before San Francisco rebounds. What do you think about that, Haith? What do you think about the article?
Yeah, I mean, so the article is very vague. It does not mention, specific numbers as far as what area we're looking in San Francisco. If we're considering San Francisco as a whole, it should include maybe a very large number. If we're just concentrating on the downtown corridor, right? Because from just my understanding, San Francisco, according to when I was looking up on CoStar a few months ago, we have about 150 to 190 million square foot of office space in San Francisco, but it depends on what area. If you're looking at just the downtown corridor, it's a little bit less. So the suburbs are still doing not well, but they're still doing about 10 to 13% vacancy. The downtown is what's taken the core of the hit. That's where the averages are anywhere from 25 to 30%. So
Right.
It's a mix of both. I mean, there's always opportunities in all markets, but it is true, if you have almost 190, 150 million square foot plus some new construction, about 1 million or 2 million, that's usually coming into the market in San Francisco. It is worrying because who is able to afford those kind of big square footage, if we look back historically, when San Francisco was booming, when we had low interest rate environment up until 2022, when we started to take off, the cost to borrow for a venture capitalist firm, for a private equity firm, were so low they could go into these offices a lot more cheaply. But now that same cost is astronomical. So the article is, I agree with it in the sense that, yeah, it will take quite some time for recovery, because we're talking about million square foot is what the article said is needed. To put it into perspective, Diamond Ridge, one of our bigger properties, is around, I want to say, 300,000 square foot. So million square foot is quite a bit of tough task to ask to fill up, especially. And the other concern that what drew my eyes was the loans coming due in 2024 and 2025, and how that will impact the overall market, because most of these loans are underwater at the moment. So
Right.
it'll be interesting to see how that's going to play out, especially because most of
Yeah.
these companies that were hoping to maybe refi or pull cash out are likely looking to do cash injections of some sort, or they'll have to get very creative on the financing component.
Right. Right. So, yeah, no, I agree with that. So, I mean, I have a little bit of a contrary take here. So, while I agree on the basis and the premise that it's going to take a long time for San Francisco to recover,
Mhm.
I do think it's going to recover. And the reason why I say that is, I've been living in San Francisco in the Bay Area my entire life, and I just don't see San Francisco fading away in general, right? I think that San Francisco is always going to be a staple of a city, and the reason why I say that is because it is always going to be a technology hub, and the technology sector is only getting stronger. With the boom of AI and all these AI companies, like, where are they located? They're going to be located in the San Francisco Bay Area. So I think that the innovation is going to continue to come out of San Francisco, and obviously there are tech hubs popping all over the country, but I think that San Francisco will continue to be a staple. Now, if you believe San Francisco will rebound, let's remove the timeline, and let's say you believe that San Francisco is going to rebound. Then the contrary opinion is that now is actually the time to be buying up San Francisco office, right? Because the Warren Buffett quote, you got to be fearful when others are greedy, and greedy when others are fearful. And there is a lot of fear in the San Francisco office market right now, which means that there's opportunity. Obviously, it will take a very bold, investor to be buying up San Francisco office, but I believe that is a bet to make if you are bullish on San Francisco long term, which I think that I am. So, hey, I don't know if you have any other opinions to kind of opine on that, but we can kind of transition otherwise.
Yeah, I mean, to put it into perspective a little bit, OpenAI, one of the biggest AI companies right out there, they leased 480,000 square foot.
Yeah.
So that's one of the bigger companies you're talking about. So when we have a target of hitting 1 million square foot to 2 million square foot a year, it's still a bit tough on that end. But
Yeah.
there will be opportunities when you're looking at maybe a smaller building in San Francisco, or maybe in a better area, or more up and coming area or something. So like you mentioned, there's always going to be opportunities in the area. It's just going to be dependent on where it is and how the location is, and the square footage you have. If you can get below that, or get to that average of 10% vacancy, the properties should potentially cash flow at that point.
Yep.
But at 22 to 30%, it's just very difficult, especially with the high cost of debt that you would have associated with getting into the property as well.
Absolutely. Absolutely. So, ladies and gentlemen, that is the current event of today. Very interesting kind of topic. So, let us know your thoughts in the chat, or reach out to us. Let us know what your thoughts are on San Francisco office. We'll transition to the main topic of the episode today, and so I'll kind of cue this up. When you're a real estate investor, right? Real estate investing is a game that is all about the numbers, right? It is not incredibly complicated math, but you have to do the math. You have to run the numbers. The fact of the matter is, whether you're buying a single family house, a fourplex, or you're buying a 100-unit or more apartment building, you have to run the numbers. And if you don't run those numbers, and you don't have a brain or an amazing underwriter like Hait, you might fall into the trap of buying a deal that just doesn't pencil out. And there's nothing worse, Hait, than buying a deal that you think is going to cash flow, but every single month after you kind of pay all your expenses, that property is actually negative cash flowing and actually losing you money. So what we want to do today, folks, is we want to kind of open the curtain a little bit and show what DeRosa does to really understand if a deal that we receive from our brokers is a good deal, right? And we want to kind of, obviously Hait spends a lot of time doing this, but to the extent that we can, show you our process, show you the rigorous criteria that we put a deal through before we as DeRosa say, okay, this looks like a good deal, and then bring it to our investors. So Hait is going to do the majority of the talking today, but before we kind of jump into it, Hait, you want to kind of like queue up, the episode for today and like what we're going to be talking about with respect to your underwriting process?
Yeah, so the property we're looking at particularly today is a property we actually did worked on about a couple months ago. It was a deal presented to us in North Carolina. It's 42 units, and it's a brand new 2024 build, new construction. The broker had very good information. It's in a very nice and up-and-coming area where we wanted to be. The location was excellent. So there's a little background, and then we'll go dig right into it. Just give me one moment. All right, let me know if you can see the screen here.
Yep, I can see it.
Okay, so a little bit of background. Like I mentioned, 42 units. The asking price on this was around $205,000 per unit. When we underwrote, we were based on the market rents and the growth and everything, it looked like an appropriate property for us to pursue further. So on this particular property, Justin and Tara actually visited the property. They did their tour. They had one of the contractors with them, just to get opinions from everyone. Also looking at it from a management perspective, what it would take to get the numbers we are hoping to get. So the deal size, the purchase price on 42 units would have been about roughly $8.6 million. So the property itself has we had 1-bedroom units and 2-bedroom units. The size is pretty in today's standards, the size is pretty big for the 1-bedroom units at 850 square foot, and the 2 bedrooms were at 1,050. The rents that they're currently getting are $1,395 and $1,575. And the rents that we were hoping to pursue on both these units are right here. We were hoping to take the 1-bedrooms to $1,450 and the 2-bedrooms from current $1,575 to $1,700. The reason being is they had a very quick lease up period where they were pushing, concessions and lower rents. So our objective was in year from now is to push rents and get more renewals upwards to where market rent is. Market rent in this specific area for 2 bedrooms is about 18 or 17 to 1,800. So we were just our plan was to get all the 2 bedrooms to market rent. Market rent for 1 bedroom is anywhere from 1,400 to 1,500, depending on the property and the amenities offered. Since this is a 42 unit property, we particularly did not have all the amenities that we can compete with the bigger developments in the area that are 200, 300 units where they have gym, pool, some sort of a deck, pub, bike sharing programs, and some even have golf simulators. So we could not compete against the amenity package. So we are usually settling on the lower end of the rent growth.
I kind of want to pause here, Hait, and kind of emphasize something. One of the things that I see, and you can probably speak to this as well, when you're evaluating deals that are put in front of you by syndicators, this is one of the assumptions that you really have to try to understand if you're comfortable with as an investor, because a lot of the pitfalls that came from these deals that are now going south are too aggressive rent growth assumptions, right, Hait? We are gone are the days that we're seeing rent growth in the double digits every single year, right? And so what Hait has said here is, look, market rent for a 2-bedroom unit is anywhere from 17 to 1,800. Some underwriters would just go straight to the 1,800 number. But what Hait did was say, look, those places are getting 1,800 because of the amenities package, right? Which this property does not have. And so he said, let's go to the lower end of the market rent range because it's not realistic. And I think that's one thing I want to emphasize here is a realistic assumption on rent growth. If you don't have a realistic assumption on rent growth, you're going to go acquire that property. You're not going to get that rent, and it's going to flow through to the bottom line, right? And so I just want to emphasize that point right here. We are very conservative at DeRosa, and this is just an example of how we're being conservative in how we review these deals. So sorry, Hait, continue.
No, that's a very good point, and that was the reflection of it, right? Is that even if the market is at 1,800, does our property compete against the comp set, right? So, in not smaller markets, in tier 2 cities, it's very hard to get a good comp set where you are comparing our property with a very similar property, because this is a 42 unit in a new area. Most of the surrounding properties were 80 to 200, and one was even 300 unit property. So just to get a gist of the proper comp set, if we compare to a property that's, let's say, maybe 6-7 miles away, it's just not in the same vicinities, not same school district, not the same environment anymore. So that's where we started initially, is how, we did our preliminary underwriting, and then we had the asset management team, which came in and looked at how much we can grow. So since it's a new property, we did not have a trailing 12. We had a very, we had a trailing 6, but it wasn't the best because it's a ramp up, right? The property is leasing up, the property is ramping up. They have not utilized everything that they can. So we planned on building a revenue item, and by collecting about 12,000 or so through various different fees that would be structured on this deal. The other thing that we plan to implement was likely a RUBS program. And RUBS program, depending on your area and where you live, depending on the state, it's either allowed or not allowed. So you need to know your laws within the state. North Carolina RUBS, excuse me. So we were planning on doing a RUBS program because right now the property had about 80% or so of people paying for their own utilities. Because the property is sub-metered, the electrical and everything is already being taken care of the tenants. We just plan on building it up to 95% by year 2 and onwards. Our cost and everything, we take a look at it with our asset management and our
real quick, Hait, we sorry to interrupt you. We have a question in the chat from Kevin Norton. Hi, Kevin. Is this building vacant and just leasing up?
So the building got its certificate of occupancy back in March. So they are currently at about 80% occupancy. When we last took a look at them, they're likely reaching that threshold of 90% as we speak at the moment. Okay. So it did take them, 3 months, 3 to 4 months to get to 90%. But it's a 42 units, so it was a quicker lease up period compared to, let's say, a bigger 150 to 200 unit, where it might take you, anywhere from 6 to 8 months to do the lease up period there to get to 90%. So once we took a deeper dive into what we think DeRosa, so this property was particularly in DeRosa Living's territory. So we had DeRosa Living take a look at the property, and these are some of the assumptions that we came up with in terms of what our cost and our assumptions would be. Biggest constraint in this particular market was that property taxes are very high, and there was no abatement or TIF or anything to offset the property taxes. So that would affect our cash flow overall, because 60 to 8,000 on a 42 unit is pretty high number, especially since there's no TIF or abatement. It's just, adds a lot to the bottom line for us. A rent growth assumption, we assumed a rent growth of 4% in the first 2 years. The reason being, again, it's a brand new property. It's a modern area. It's also grown in the, was in the Greensboro greater metropolitan area. And Greensboro, North Carolina is one of the fastest growing in the country. It's usually outperforming the rest of the nation. So we felt appropriate to, do 4% rent growth in the first 2 years and then stabilize the property at 3.5% after that. Expense growth, again, 2% is just matching inflation and where things would be. We're already pushing for higher expense assumptions as is. from a price per unit, we're looking at about 6,200 in total expenses. So we thought that was a pretty appropriate number, and then we just grew with inflation after that. And since this is a brand new property, the repairs and maintenance and the turnover budget is likely going to be saved during the first 5-6 years. This particular property had warranties for the next 3 years, so our repairs and maintenance budget would have been very low because of the warranties. So we are being a bit more conservative in that we are accounting for the 8,400, but it likely would have been a lot lower scenario because the property is going to come with 5 years of warranties. So the other thing I wanted to mention, we can quickly take a look at, is how we are valuing the property and how we are looking at the property in terms of the hold period. So our hold on this property would have been about 10 years. And the reason being is right now, as it is, the debt terms that we get on a 10-year versus a 5 year or 7 year, 10 years is going to have the most attractive debt terms. Once we talked to our lender, we were getting the issues we ran into this property is the affordability factor. If you know, Freddie and Fannie Mae are the two agency debt lenders that we talked to, but this property would not have qualified for the AMI factors in the area. So we wouldn't have been able to get the most leverage, and we would not have been got the best interest rate because of the affordability factors. On our initial talk with the lenders, we were getting anywhere from 220 spread to 250 spread on this particular property. And it's also during, the property has to stabilize. So Freddie and Fannie, they want to see a stable T1 or T3. The reason, or we can also utilize what they have is called a stabilized program, where Freddie and Fannie have a stabilized program that we could potentially use that, but the interest rate would have been a bit higher. So, the best terms we were looking at on this, just based on today's interest rate, where Treasury is what about a 220 spread brings us to about a 6.5 interest rate. However, we would have gotten likely about 5 years of IO on this deal, and we would have done a supplemental loan in year 3 when we have built up the property. We have done the implementations we need from the DeRosa Living side, brought up the revenue, brought up NOI to a sustainable level. We would have pulled in about additional 1.5 million or so of supplemental loan in year 3 from now. And the folks that don't know how supplemental works at the moment, supplemental, let's say if the current interest rate is 6.5, if you wanted to pull a supplement today, you're probably looking at least 100 basis points higher. So you're probably looking at a supplemental at 7.5% interest rate. So we're looking at a blended interest rate on a supplemental loan. So there's a lot of various different factors that we're looking at, especially when we're underwriting properties as such. But this property, so the timeline, okay, initial thoughts were, all right, it looks good. We underwrote it very conservatively in terms that we have, a bit more rent growth left. Let's say if we could push it to 1,800, everything for 2 bedrooms. So what happened next? We discussed this internally. We scheduled our property tour, and then we got the feedback from our asset management and property management team that, hey, we don't think this 1,700 is even achievable. We're likely looking at maybe 1,600 or so rent for our 2 bedrooms, maybe maxing out at 1,625. The reason being is because this area is new and it's has almost additional for 350 units coming into this area. Vacancy rates are going up because of that. So vacancy rates in this particular area jumped from what was at 5% vacancy. It has currently about 12% vacancy. So that would have caused us to achieve our plan that we have of taking the rents up to 1,700. So, excuse me. So we actually changed this down to 1,625, and we changed our vacancy from, since we are a smaller property, we took it from 5 to 7% for the hold of the property, because I think 7% vacancy would have still been achievable. The returns for us and our investors just did not work for us at that point. Our deal level IRR was before in the 13s, and we were hoping to build it up from there to a higher level, maybe 14 to 15 a deal level, or if not 16% deal level IRR. We had the conservatism built in, and we were going to check against that to see if we can achieve rents of 1,800, if we can get more income out of the property, such as a valet trash system, maybe Wi-Fi fees, amenity fees, and anything. But those are just not achievable in this particular market because of the growth the market has had and the vacancy that is out there right now. There are a lot of other apartment complexes giving concessions to their tenants and residents. So we would not have been able to compete with that. So overall, when we looked at the deal at initial terms, it looked very good. By the time we did the property tour and got into the apartments, and the other thing that we did not like was the construction itself. It was almost a class B minus construction. When the property, or when our asset management and property management team visited the property, they already had water leaks. The gutters were not working correctly. So it just felt like it was a very rushed construction. So that was the other appetite that did not appeal to us. So that, combined with where the returns were, we did look at, what happens, what number does the deal work for us. And the deal would have still been attractable, like around 8 million and lower. So, after the conversation with the broker, they just 190,000 a unit on 2024 built asset is not the price that assets sell for anymore. So we just backed out of the deal at that point, and we did not want to pursue the deal any further because of the construction quality as well as the plan and how the area is going so quickly. There might be additional units coming maybe next year as well, which would again impact our rent growth along with where our vacancy would be.
Awesome. Hey, we had another question from Kevin. I think we did touch on this. Kevin says, thanks. If the occupancy is below 90%, what type of financing will you be sourcing? I may be getting ahead of your presentation. So I do think you touched on this, but maybe we can kind of revisit that to make sure we answer that question.
Yeah, we can spend a bit more time on that, Kevin. So there's multiple different options you can do when your property is below 90%. Couple would be, regional bank or credit union would also be a potential there. As long they might look at the DSCR, maybe if that's healthy, or if there's a plan to get to 90%, you can definitely have a conversation with them. Another one we look at and what we utilize a lot is bridge debt. But bridge debt right now is very, very high. We're talking SOFR plus 300, SOFR plus 200, depending on the deal and how much the deal needs to get to that level of 90%. So there's different debts available to you. And if you want, I can even, get you in touch with proper people that would know about more of the debt side of things and what will be the most appropriate on a deal. The only constraints you might have is some of the bridge lenders, particularly, just not might be looking at smaller deals. They're probably looking at, loan sizes upwards of 10 million and onwards, which at that point, there are specific lenders that would be able to look at deals that are on a smaller scale.
Awesome. So, hey, thank you for walking through that. There's a lot to unpack here, and I want to spend a little bit of time kind of talking about this and making sure our audience has an opportunity to ask any questions as well. But so we received this deal, folks, and it, on the surface, like Hait said, looked very, very good, right? It was a 2024 build. It was in our wheelhouse in terms of the markets we're looking for. It looks like the price per unit looked attractive to us. And when we did a very high level kind of underwriting with our preliminary assumptions, the deal looked like it worked well, kind of in that 13 to 14% IRR range. So it warranted a property tour. It warranted an additional look to kind of validate our initial assumptions. And that part is very, very important, right? Hait said, hey, this is kind of what we think. And we already layer in an element of being conservative, making sure we're not pushing rents too high in that kind of preliminary assumption. But then our asset management team comes in, they tour the property, they take a closer look at the area, and they note a couple of things. They say, hey, I think 1,700 from a rent perspective is already too aggressive. There is increasing supply in this market. The vacancy rates are increasing. we don't think we can even achieve 1700. We think we can achieve 1625, 1650, right? So while we already thought we were being conservative, the asset management team is coming in and saying, no, we're not being conservative enough, right? So Hait reruns his numbers, and then that deal falls kind of below the threshold of what the returns are in terms of being attractive enough for our investors. That is how thin the margins are right now in the space, right? In terms of there's such a fine line between what is a deal and what is not a deal. You know, obviously there are going to be home run deals, but you have to, as either a syndicator or as an investor, this is what you have to understand, right? Like if your syndicator or your operator is not applying this lens of conservatism, right, the deal could be on the fine lines of the margins, and you could just be, not seeing the reality of the situation. We could have not toured the property and could have not said, we could have been like, yeah, 1700 is great, right? And then we would have been in a bad situation because we're not addressing the reality of the situation. And I think a lot of operators have to be more strict with their underwriting, be more conservative, because right now is the time to really, really shore up and really, really feel confident about the underwriting. So, Hait, I kind of want to turn it back over to you. Just speak about that a little bit more. You know what I mean? Like how we obviously we wanted this deal to work out. It would be great to have a 2024 asset. It'd be great to, build up more of a presence in the markets that we're operating in now. But as painful as it is for us and our investors, we have to make sure that we're applying this lens of conservatism.
No, you're absolutely correct. If we really wanted to make the deal work, the projections could have been skewed, or the exit cap that we have at 5.3% 10 years from now could have dropped it down into sub 4 level, right? Where we were, back in 2020 up to 2022. In this particular area we were at, that's why I have this reference here, we were at about 4.7 cap rate in this particular area. So we could have done that as well, just to look at it from a financial perspective. But we also have to be very aware of where we are. We don't want to over lever the deal. You're going into the deal very healthy. We also have to look at our DSCR constraints. How are we going to be able to get finance and pay off our debt service every month along with our cash flow and everything. So when we're building in conservatism and how we're looking at the deal is very, when you say today's market is a very challenge. Deals we are looking at are going to be particularly value add or new construction, and we do the lease up where we would be achieve the value add we need because we are doing the lease up and getting it to a certain point. This particular deal just did not work because of the supply coming into the market, which might be an issue in other markets as well. And supply coming in is not just, it's class A, class B as well. So the competition would have been too much on this property.
Absolutely. No, and I think that's another important point to kind of emphasize, Hait. If you have to be very aware of where the supply is increasing and kind of outpacing which markets, right? So it's very important to know there are markets right now that are having a lot of supply growth, right? The Sun Belt in particular is having an immense amount of supply growth, right? Like Texas, Florida, Atlanta, all these places are just having an immense amount of supply growth. So whatever city you live in, look around. Like, do you see cranes in the sky? Are you seeing apartment buildings come up? And that supply growth, Hait, correct me if I'm wrong, it is really happening in kind of those higher tiers. Because from a builder perspective, right, if you can build something and you're going to you'd rather get a premium on the rent growth. So you're really building kind of class A luxury. But when you have such an increase in class A luxury and your priority is to lease those buildings up, right? If you're doing that and then you have a bunch of class Bs and even class Cs in that market, what are you going to do as a class A luxury operator? You're going to make a lot of concessions, right? And so the more concessions you make to lease that building up, what happens? The rent range compresses much more tightly in a market that has a lot of supply growth. And so what if I'm moving, let's say Dallas, Texas, or wherever, Austin, Texas, right? And I'm moving to Austin, Texas, and I have a class A building with all the amenities that is a certain rent range. And it's only, after all the concessions, is only like $100, $200 more than a class B building. Where am I going to move? I'm going to be moving to that class A luxury building. And so all these Class B buildings and Class C buildings, they're getting really crunched, right? And so I think this is one of the things that you have to understand is like, what is the supply growth dynamics in the market that you're looking to invest? Is there a lot of supply growth? Is there a lot of luxury being deployed and built in that market? Or is it not? There's a lot of markets where supply growth is not happening. Actually, whatever you think about San Francisco, there's not a lot of supply growth in terms of buildings, multifamily buildings in San Francisco and the Bay Area in general. I know some places in the Midwest is still not seeing supply growth, like heavy supply growth. And that's why you're seeing actually places like Cincinnati have super strong rent growth because the supply is just not coming. And so that's just like one thing to kind of emphasize, Hait, is like, you have to understand as an operator and as an investor, what are the impacts of supply growth on rent assumptions? So what do you think about that, Hait?
No, and particularly the way we look at it is, what is our delta? Like if we are at 1,700 for our 2 bedrooms, what is Class A at? Do we have a delta of, are they $100 higher, 200, 300? What are we look at that, and we also compare our property to a Class C where they have done a renovation per se, and see where those guys are coming in on their 2 bedrooms, right? Because you want to be, if you're a Class B, you have to be very positioned in the particular space. If you're Class A is trying to grab from you, can you go after the other demographic underneath or not? It's just like you said, the constraints are there. But then what is our delta currently? What are the differentiating different within the same market? So we did look at that. Class A in this particular market, there actually weren't many Class A buildings in this location. So it was mostly just Class B, newer construction within the past 3-4 years. So that was not a concern here. And the delta from Class C to Class B, such as this property, was almost $400. So we felt pretty confident that, we should be able to achieve and keep the rents where they are at, especially at the 1625.
Yeah, absolutely. One question I have for you, Hait, is a couple things, right? So DeRosa, typically our portfolio, we have mostly a value add portfolio, like 1980s, slightly newer kind of assets where we do the value add component. Besides our Red Wing deal that we just closed in Red Wing, Minnesota, we don't have a lot of new builds, a lot of newer assets and things like that. So speak to our audience a little bit about our openness now as DeRosa to looking at these newer assets, these newer constructions, like that strategic shift at this point in the market cycle. Like, why does that make sense for DeRosa right now?
Yeah, so it actually goes back to Kevin's question in regards to financing, right?
Yeah.
If we are looking at a 1980s building, let's say, good community, 100 plus units, if we have to take on bridge debt, which is costing us about 9%, we're just not going to have enough juice in the deal. Also, what just talked about, rent growth, is it actually achievable to put, let's say, 10 to 12,000 per unit and achieve $150 to $200 rent bumps in this current market and state we are at? Also to take into account affordability factors. When we look at the demographic that is in the residents that will be in this 1980s unit property, what is the affordability factors? At that 30% threshold, they're already mostly maxed out at that point. The property valuations also in the market, which is also very skewed at the moment, is people are still valuing and their underperforming assets are still selling on a price per unit basis. So we just don't have enough opportunities to penetrate that particular market. But yeah, the rent growth, especially even after a capex, throwing in 10 to 12,000 is not there. Then along with financing, right? Once we have a bridge debt for, let's say, 2 years, we get out of there and then we go into agency debt. That's when we'll likely start to cash flow. But during those 2 years, we'll have a lot of holding costs and everything associated with that. So is it worth it to take on a riskier asset like that, or would you be willing to put more into a new development at that point? And then why I mentioned 1980s is buildings older than that now are going to run into insurance issues. Your repairs and maintenance costs are going to be higher, as you likely might have to replace. Roofs are always a replacement that you have to do every 20, 25, 30 years. Or then now you're also talking about sewer replacement, water line replacement, electrical upgrades, sprinklers. So those kind of costs are just adding up at the moment.
Yeah.
The past 3 years, we have seen are, contractors, let's say an HVAC contractor back in 2020, what would it cost like 20,000 for HVAC now probably cost 30, 40,000. So, when we're replacing the bigger HVAC system on everything, our costs have gone up astronomically. So to keep the 1960s, 1970s property in a good condition and everything, the repairs and maintenance and the turn and the budgets just need to be a lot higher. And that point, it's just does not cash flow enough for us. Neither are the returns good, because we also have to look at the exit. If we buy a 1960s asset today, if we hold it for 10 years, who's our buyer pool at the end of year 10? Is that buyer pool going to shrink over time, or is it getting bigger? In my opinion, very likely that buyer pool is shrinking as more and more people are moving to newer properties and newer age properties. So
Absolutely. And
that is always a concern from any perspective. We have to look at two exit, scenarios in best case.
yeah, this is so important. This is incredibly important, right? Like I talk to a lot of investors, and I think there's such a heavy focus on the returns, Haith, right? The IRR, the equity multiple, the cash on cash return. And obviously, as you should know or be able to expect what returns you're going to get.
Yeah.
But there is so much more to the deal than just the returns. You can't just jump straight to the returns, because those returns are very different depending on the asset itself. If a syndicator is telling you, hey, we're going to get a 13% IRR, and this asset is built in 2023. And then there's a syndicator saying, we're going to get this, 15% IRR, but the asset is built in 1975.
Yeah.
Now, if I'm an investor that just focuses on returns, I'm going to look at that and say, oh, I want the 15% IRR deal. I want the higher IRR deal. But what you have to ask yourself is, what is the risk premium that you're getting, or that you're getting for this deal by taking an older asset? And you have to ask yourself, is that risk premium high enough? You should be getting a higher return because the asset is a lot riskier. But is that delta, that 13% versus the 15%, is that big enough? And is that warranting the additional amount of risk that you're getting? So I guess my point here, Haith, is as an investor, you have to look beyond the returns. You have to think about everything that Haith is saying. In terms of us as DeRosa, we underwrite these deals as an operator, and we weigh all these factors, but you should be weighing these same factors as an investor as well, right? And you have to have that lens. So I guess, Haith, my point is that don't just think about the IRR, right? Think about it more holistically from a strategic perspective, and put your shoes in the shoes of the operator, right? We don't want to take an additional amount of risk, and that's why we're shifting to these newer assets, because we see this kind of shift in the market. And so have that lens as an investor as well. So, hey, what are your kind of thoughts on that?
No, I mean, that's why I agree. We compared it to like bonds, right? You have your AAA, you have your B, and you have your junk bonds. The returns on AAA lower, B a bit higher. Junk is going to have the highest, but the default rate is also higher on junk bond, right? So the risk premium definitely has to be considered when you're looking at assets, especially even new construction is going to have the risk of a lease up. And what Kevin mentioned, Kevin brought up another good point in the chat, is that when you're buying a property that's leased up, what kind of lease up program did the property management company or the development company have in place, and how did they did they just lease up and fill it up basically? And you are now going to get residents that are not the best. You might have bad debt, you might have to flip them around and everything, or it might not be the best in terms of how it shows. So yeah, new construction also has that risk when we're buying those assets as well. But if we are doing the new construction ourselves, which is the case in Red Wing, then it's a different scenario, because we are the ones doing the lease up as well. That's why I mentioned when we're looking at new construction deals, we're looking at deals where we are particularly doing the lease up, because then we control the property from day one until exit. So the risk associated with that goes a bit lower. But to Kevin's point, if you're buying a property that was recently leased up, let's say 2 months ago, and you're buying it at 95% occupancy, we have to do a very, very, very thorough due diligence check to make sure the residents and everything are qualified to meet the market rents and the demographic, and they can support what they signed up for. In terms of the risk associated with older buildings, depending on the area, if you're looking at a 1980s building, particularly in the Triad area in Greensboro, Winston-Salem, The returns are definitely there. The buyer pool for 1980s, we believe, are still going to be pretty active within the 5 to 10 years. So we're still looking at that. But when we look at it older, like 1960s to 1970s, the buyer pool for that is shrinking. Obviously, when you're talking about a 2020 for new construction, very built property, 10 years down the road, the buyer pool is going to be a lot bigger for that particular product. We're also looking at what, when we're looking at properties, we are looking for a particular size. We don't want to be below like a certain point where the buyer pool again is smaller because, you know, the deal is just not big enough for most people. So we also have to take that into account when we're looking at deals. Is the deal size itself is, I'm just making up a number, is anywhere from like, let's say particularly 8 to 15 million, where the buyer pool is bigger. Or if you're looking at bigger deals like 200 plus development, then you're talking more of institutional buyers. So, when we look at exits, we're also looking at different that. Who is our demographic at exit? What is the buyer pool? How we'll be able to accomplish our exit price and everything as well. So there's a lot that goes into the underwriting, but on initial, just this particular example we looked at, this was just our round one, and it did not pass our phase one, I would say. After this, we would have a lot more conversation in depth about budgeting, rent growth again, everything going back after the property tour, seeing where the latest data sets in the particular market is. Everything would be compared, and we would also see where the latest comp sets are coming at, especially from a sales perspective. In this property selling for 204,000, what are the other properties in the area and how are they selling at? So this was our phase one, and the property didn't meet our expectations. So then it's kind of just time to move on at that point.
Absolutely. And yeah, I mean, this is just phase one, folks. And like Hait said, there's many rounds of underwriting to really make sure it's a good deal for our investors. And so we just wanted to kind of peel back the curtain a little bit today, show you guys what our process is, and show you guys, the steps that we take to make sure that a deal is a good deal before we bring it to our investors. This particular example, the deal was not good enough. And so we close the books on it and move on, right? And we move on to other more promising deals, which we have many. To kind of tease it a little bit, we are going to be launching DeRosa Capital 19, in maybe a month or so, Hait. But this is a deal that obviously passed all of the rounds of our underwriting, and it is a very good deal. And so if you want to, stay in the loop and make sure that you're keeping up with all the latest deals that we're going to be launching, feel free to go ahead and book a call with me. I'm the head of investor relations. I'd love to chat with you, learn about what your investing goals are, and make sure that you stay in the loop with all of our latest deals. Hait and the acquisitions team also have a monthly acquisitions newsletter where we kind of crystallize all of the underwriting activity and acquisitions activity that we have going on as well. So if you're not on our email list, you want to get on the email list to make sure that you can stay up to date with all of our kind of acquisitions activity. That is all the time that we have for you today. We hope you found a lot of value in this episode. I want to thank Hait, the one and only, for joining us today and sharing his underwriting knowledge. I am your host for today, Jacob Sandoval, head of investor relations for the DeRosa Group. This is the Cash Flow Digest. We will see you next Friday. Peace.
All right.